Thanks for checking out today's video where we're going to talk about a pretty powerful tool for traders. It's called a Double Smoothed Stochastic Oscillator, DSS for short. And it offers a smooth version of the traditional stochastics oscillator. So it's going to provide a more refined and less volatile signal. And by the end of this video, you're going to have a clear understanding of how it works and how you can make better trading decisions with it. So let's dive into it. What exactly is it? So it was created by a guy named William Blau, the Double Smoothed Stochastic Oscillator. And what it does, it applies EMAs, exponential moving averages, to a standard stochastic %K. So this is going to give you a smoother curve compared to that raw stochastic. And traders are going to use the DSS to analyze trends, identify overbought and oversold regions, even spot divergence. So how is it different from the traditional one? Well, a few ways. The raw one can produce choppy signals in volatile markets. The DSS is going to give you a smoother, a more responsive way to interpret the data. Using the exponential moving averages, it also has two different periods where the traditional one uses simple moving averages. There's also slightly different buy and sell signals that are compared to the traditional stochastics. So what is the concept behind it? Again, involves applying EMAs of two different periods to the highest high and lowest low for a specified period. So these smooth components are then used to calculate the DSS value. It's going to range from 0 to 100. So it plots on your chart. It's an oscillator. Values above 70 indicate overbought. Below 30 are oversold. One key thing to note is it's suitable for all traders. Doesn't matter what your experience level. Provides a clear, more reliable signal. It's easier to read. I think it'd help you make better decisions. But before you use it live, it's really important you test it out and assess its effectiveness in your trading strategy. If you back test it, you use historical data, of course. You can forward test it as well with live data. But then you can determine how that DSS performed in different market conditions in the past. So this is going to give you some valuable insight into its strengths and its weaknesses. But remember, it's past data. It's historical. So we're going to talk about divergence with it. And it's really important to note it can be a pretty valuable complement to other analysis tools like trend lines or support and resistance levels. And when you combine it with these tools, you can further enhance your decisions that you make when you're trading. So divergence occurs when there's a discrepancy between the price action and the oscillator. So bullish divergence. Price makes a lower low, but the DSS forms a higher low. On the other hand, bearish divergence is when the price makes a higher high, but the DSS is forming a lower high. When you spot these divergences, it can indicate potential trend reversals and give you some pretty valuable insight for your trades. Remember, nothing's guaranteed. Some key signals to watch out for with this. When the readings are above 70 or 80, it suggests that the asset's overbought and it could experience a bearish reversal soon, but it could also go into a trading range. On the flip side of that, 20 or 30, it implies that the asset's oversold. I might see a bullish reversal. Again, it also may just go into a trading range. When we talk about crossovers above the 70, followed by a crossover back below the 70, that could be a sell signal. Crossovers below 30 and then followed by a crossover back above 30 could be your buy signal. So some of the advantages, there's a few. Again, it's a smoother curve. It filters out some of the noise that you're going to see in the raw stochastics indicator. Makes it easier to read, makes it easier to interpret. Second, it can help you identify potential trend reversals with greater accuracy because of the double smoothing process and the EMAs. And when you use divergence, when you spot that, you may see them earlier than you would with a traditional stochastics oscillator. So when you incorporate it into your strategy, you can benefit from a clearer view of market trends and trading opportunities. Again, smoother, less volatile signal. It's going to allow you to better identify overbought and oversold conditions as well as divergence. And this can all help you generate better trades. However, it's important to remember no single indicator should be used in isolation. Market conditions are always changing. Make sure you understand price action and perhaps another indicator or two. Talking about indicators, you can get your hands on our trading indicator blueprint totally free. Other people are out there charging $197 for this kind of course, but we're going to give it to you. The link is over here to the left or down below in the description. It's over 50 pages of insights. Plus you get 4 solid training videos. Again, it's all free. Anyways, thanks for watching. Any questions or comments, you can pop them below. Hit like, hit subscribe. We'll talk to you soon.